Most people think the income statement and balance sheet are two separate reports, but that is completely wrong. They aren't different documents at all. They are the exact same system. And if you don't understand how they connect, accounting will always feel like rules you have to memorize. Think of them as two different perspectives on the exact same cash and operations. The income statement tracks the performance over time, while the balance sheet stores the net result. Before we look at the numbers, you need to understand the ultimate mental model. The income statement is a movie tracking activity over time. The balance sheet is a frozen photograph. One tracks your business's momentum, while the other captures where it stands at one exact point in time. The core riddle of accounting is understanding exactly how the momentum of the movie gets frozen inside the photograph. How does net income leave the running engine and step into the static snapshot? The single link connecting these two universes is net income flowing straight into retained earnings. This is where the magic happens. Net income from the performance report explicitly populates retained earnings on the snapshot. Let's look at a concrete example. Imagine your cafe lands a corporate catering job. They pay you 1,000 euros in cash straight away. This is our starting point. To log this event into our business books, our data ecosystem splits the transaction into two corresponding adjustments. First, we debit our cash account for 1,000 euros, signaling an expansion of our liquid cash resources. Simultaneously, we credit our revenue account for 1,000 euros, explicitly tracking the operational performance source. But making money costs money. To deliver that catering setup, you have to support clear operating expenses. Between coffee beans, team wages, and electricity, your cash drops by 600 euros. Just like our revenue, these operational costs must be balanced across our books. We credit cash for 600 euros, showing that cold cash has physically departed our asset accounts. At the same time, we debit expenses for 600 euros to increase our total calculated cost of doing business. At the end of the period, we stack these totals together inside our performance dashboard. We start with our top line revenue of 1,000 euros. Then we subtract our recorded operating expenses of 600 euros, leaving your cafe with a final net income of 400 euros. This elegant structure is your official income statement. It captures the dynamic performance movie over a defined window of time, answering one fundamental question: how did our cafe perform and what did we actually keep as net income? Remember, an income statement never reveals what your business owns at any isolated second. Instead, it tracks your financial performance over time, showing how much value moved through your doors from start to finish. Now, let's transition over and examine our static snapshot, the balance sheet. We look inside our vault and see our real asset, 400 euros in net cash from our operations. But notice something dangerous. Our structural equation is broken. Total assets do not match equity and liabilities. This is exactly where newcomers to business math get stuck. The equation tilts heavily to one side because your recent profit hasn't been linked to your equity foundation. Right now, the cash asset exists physically, but the equity side doesn't know where it came from. The critical link required to resolve this friction is called retained earnings. This account acts as the structural gateway, carrying over net performance values straight into the equity pool. At the absolute end of our financial interval, we initiate what accountants call closing entries. We safely empty our temporary income statements accounts, considering the net performance into a single number, and flushing it directly into retained earnings. Instantly, our complete landscape locks into perfect structural balance. When we clear the financial report at the end of the interval, that net income doesn't vanish into thin air. Instead, that 400 euros of profit crystallizes into an active vehicle of equity moving onto the balance sheet. The core profit value slides dynamically out of our operations view and down into the equity stack. This account houses the ongoing internal wealth the business retains and reinvests over time, balancing our assets perfectly. Now, the architectural ecosystem makes perfect sense. Cash stands at €400, matched by retained earnings at €400. Our assets match our eternal equity. The dynamic story told by the movie has now become a permanent feature of our core photograph. Every bit of operational friction is reconciled, locking in our primary formula. Assets equal liabilities plus equity. This elegant sequence maps out the complete connected flow of financial information. From data point to final balance, every element works together as one seamless system. This continuity is what financial analysts refer to as the golden thread of accounting. It binds every entry, ledger, and closing record into one single unbreakable narrative. The income statement captures the operational movie of how the engine ran over time. But where does the movie end? It ends at net income, the exact link that the golden thread carries over to lock down the structural photograph of the balance sheet. The golden thread. Once you trace this internal connection, you stop memorizing lines and start reading financial reports like a map. Subscribe to Accounting 123 now, or continue guessing if a debit goes left, right, or upside down.